Chapter 5, Managing the Trade. Building trading rules. Managing the trade means how to control where to enter and where to exit. That refers to managing the trade. So, building trade rules. So, first we have to build trade rules. The trading rules are rules used for certain rules which are essential for building a trading system. Then a trading rule is a specific action you take when certain conditions are met. That means certain conditions are met means, for example, a moving average is approaching a certain period, or moving average crossover is occurring. So that are certain conditions. So rule 1, determine the current trend. That means first we have to determine stock is in uptrend, downtrend, or in sideways trend. So first we have to determine the current trend. So that is rule 1. Then rule 2, establish the rules for opening a position. That means where to enter in the market. So that is the second rule. So we have to establish where to entry. So we have to define our entry point. So that is rule 2. Rule 3, manage the money at risk by scaling up or down. That means apply proper risk. That is how many percent of my capital we are willing to dedicate to a certain trade. That means for say 2% of entire capital we are dealing with a certain trade. For example, if capital is say $1,000, so our each trade will be $1. If we decide to risk 1% on one trade, so that is rule 3, manage the money at risk by scaling up or down. Then rule 4, establish the rules for closing positions, set stops and targets. That means set stop losses and set target. That is 1:3, etc. So we will discuss about those risk reward ratios afterwards. Then rule 5, establish a re-entry rule after being stopped after a target is hit. So after hitting target, so if we consider that our trade is now successful, so we are hitting that target. So after hitting target, what we will do? So what we will do is re-enter the market now. So where to re-enter? That is rule number 5. After being successful, what to do? So that is rule number 5. Then trading styles. So each trader has its own trading style. That means some traders are aggressive, some are slow, some are fast, some prefer fundamental investing. That means they buy a certain script or stock for a indefinite amount of time. So everyone has a different trading style. So some traders prefer one day time frame of candlestick. Some trader prefer 1 hour candlestick chart. Then some trader prefer, these are scalpers, they prefer 1 minute candlestick chart. So these are different trading styles. So as many trading styles exist as there are individual traders in the world, so trading styles exist according to individual trader in the world. So each trader has a different trading style. So these are some trading styles given below. First is system mechanical trading. System mechanical trading is that is basically, it only contains some rules. That is, if stock is above moving average, then we will buy. If it is below moving average, then we will sell that stock. So these are a totally mechanically based system which can be performed only by computer. We don't have to interfere with it after applying. So these are system mechanical trading rules. So these are truly systematic traders take every trade their indicator dictates. That means indicator is dictator here. Indicator or certain charts or certain rules, that is RSI or parabolic SAR. So these are dictators here. So their opinion is last opinion. So we don't interfere with, human don't interfere with any of the opinion. So that is system mechanical trading. Then it can be performed completely by a computer. That means no human interference is needed, so it can be performed completely by a computer. Second is system guided trading. In system guided trading, you want to apply additional techniques, usually from the non mathematical collection. So from non mathematical collection, that means along with the system mechanical trading, we apply certain rules. That means we it is a semi automatic kind of a trading. So that is system guided trading. That means we apply rules, we go according to system mechanical trading, but there is an human interference with it. That means if a stock, if the pattern is breaking out, so that is seen by human eye, so that is a human interference with it. So that is system guided trading. Then guerrilla trading. Guerrilla trading means in army or military terms, guerrilla fighting means uncertain fighting. That means fighting without knowing. It is a surprise event. So guerrilla trading is like a surprise event. So it is very unreliable kind of a way of looking at trading. So guerrilla trading, it is used by analysts that specializes in sideways market. That means it is used in sideways markets only. Then guerrilla trading is least systematic method of trading. It relies on a crowd psychology. So some traders are scalpers. So guerrilla trading is relies on crowd psychology. Then scalping is a type of guerrilla trading. So scalping is basically buying and selling very fast, in a very fast manner, or in a very less time. So risk to reward is 1 to 1 in scalping, but trading is so fast that mostly people end up in profits. So it is like trading in a very short interval. So it is a kind of a guerrilla trading. It has no uh, main indicators or no analysis, no large analysis involved. So that is a guerrilla trading.